Let's get more on these equity markets at record highs. We're joined by Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Chad, thanks very much indeed for joining us. Investors seem to think that it's just a rosy outlook. We've got the Fed apparently poised to cut interest rates. And you reckon financial conditions are pretty loose right now. It's relatively easy to raise money. Give us more.
Right. You have credit spreads that are historically tight. You have multiples across the board that are, when you look at it from a 30-year perspective, valuations on the equity markets that are on the high end of the range right now. So there's an embedded expectation that earnings growth will be quite robust in 2025 going into 2026. Which then gives, a big question on why the Federal Reserve needs to lower interest rates. And perhaps they're doing that because they want to start to gin up and try to get the housing market restarted once again here in North America.
There's two schools of thought, I think, on the market concentration in the United States. Some people think, well, of course, these giants should account for a big chunk of the market because they're so profitable and growing so fast. But you reckon about 20 companies are almost half of the value of the U.S. market. And what do you think? Is that excessive concentration?
It's excessive from a historical perspective. And of course, those companies have been powering S&P earnings higher, and those companies seem to be growing to higher highs on the revenue side. But yet there are an additional 480 companies out there that multiples have been compressed quite a bit that are really actually quite attractive from a valuation perspective. So you have the haves and the have-nots. You have that MAG 20, let's call it, that represents the higher multiple stocks. And then you have the other 480 that's multiples are compressed, but you do see a really good, I would say, tailwind for many seams of that market.
And credit spreads are tight. So companies can issue bonds at pretty low interest rates because investors are discounting risk?
Yes, absolutely. And those equities that have, let's just say, inadequate balance sheets, but are able to get easy access to the credit markets, well, their equity prices, those lower quality companies, their equity prices are somewhat more elevated. So you've seen this rally also underneath of lower quality equities that have done quite well. Any normalization of the credit system in regard to credit spreads, the impact of that will be that the equity of those companies will be materially affected with a valuation readjustment lower. So one has to be more mindful about not only high multiple stocks with concentration risk, but also going and putting your bet down on lower quality companies that have just had a real access to credit, which has ginned up their stocks.
You have some ideas for us. Grainger, GWW. What does that company do? What's the attraction?
So it's a distributor of products that they sell into the business cycle. They sell it to businesses. It's got well over 1 million SKUs that they distribute to the likes of, say, a builder or, say, for example, different factories. And it's a type of company that the multiple is quite compressed. You can get a big tailwind with this company because of the reindustrialization here in the United States. That expected reindustrialization may gin up demand for their products and volumes. The company's multiple has been compressed also because the last quarterly numbers were somewhat disappointing, but we think that that's a bit transitory. It's growing, profitable kind of company with a rising dividend stream. So we like that one for the next 3 to 5 years out.
Cisco Systems, it's been around since the turn of the century and before, networking giant. You see promise here.
Yeah, this was, just so you all know, that going back in history, this was the largest market cap stock back in the dot-com era. So this was the NVIDIA of its time. But we now see this at a reasonable multiple, trading at roughly about 16 or 17 times PE multiple for 2026. The tailwind here is that as you start to see more companies embrace artificial intelligence, they have an upgrade cycle that they need to address regarding routers, regarding data security. Cisco Systems, we believe, is a real easy way of playing or investing in the artificial intelligence build out without taking on an extreme amount of risk. So low multiple stock, growing, profitable, well capitalized, and they're buying back shares as well, and they have a rising dividend.
So the PE on estimated earnings about 17 times, and you reckon it's lower risk because it's just got such an established franchise?
It's established. They have this broad client base on the networking side. As you get to the next stage of artificial intelligence, going from the hyperscalers down to real businesses, the real business will have to then go back and look at their telecommunications networks. They will have to address upgrading that backbone. At the same time, they are participating within the hyperscaler build out. And in 2026, you should see a great strong tailwind with their international business on when it comes to that. So we think that the stars are aligned for this company. It's well diversified. It's not just a single product company, and you're not buying it at a historically high multiple. It's growing at the right price.
Chad, thank you very much indeed.
Thank you for having me.
Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors.